Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. And the talking point today are the views of Abhiram Eleswarapu. He's head of India equity at BNP Paribas and joins us right now to talk about, well, multiple points. I've noted down the things that we want to talk to him about. Obviously, aside of the equity markets, his thoughts on IT and what next, especially after the debacle that Infosys has done and the resultant pullback that we've seen in those names. We've seen relative strength coming out in BFSI in this quarter, both in terms of the fundamental performance as well as the price performance, especially in PSU banks. We try and probe him a little bit on that. What is his sense on the earnings outlook overlook at a point of time when some houses believe that we'll probably clock in a 15 to 18% earnings growth in FY24, and some believe we could actually halve from those expectations. And of course, the views on equity markets, as I said, from a medium-term perspective. Abhiram, great having you. Thanks for joining in. I hope all is well.
Thank you so much, Neeraj. Good to be here again.
Yep, and good to have you. So, Abhiram, which side of the table are you on? Are you constructive on earnings despite what we've seen from tech at the start of this earnings season? Or are you a bit circumspect about what they will do in FY24 at large?
Just before coming here, I was taking a look at our own earnings estimates for FY24, and they're in the range of about 17 odd percent growth for next year. Pretty much where I would say the index kind of growth expectations are at the moment for earnings. Now, that said, that is spread across various. And I was looking at, for example, sectors such as telcos, where there's a significantly high earnings growth expectation, whereas for metals, probably very less, and so on and so forth. So it's dispersed quite a bit. And I dare say a lot of the earnings expectations growth comes from sectors with low margins. So there's expectations of high operating leverage, which means that even if they beat margins by a little bit, earnings growth could be quite significant. That's what the estimates seem to factor in. Now, just eyeballing those numbers, I feel that you probably have to cut those numbers, maybe by 3 or 4%. And that's not strange. It happens every year. We start in April with high teens expectations because that's what is expected of India. And then later in the year, when one or two issues come up and those issues become two or three issues, then you start to pull down the numbers. So I think more sensibly and realistically speaking, we'd probably end up with around 12 to 13% earnings growth.
Okay. And where do you reckon, as per your estimate, the chief set of cuts will come in relative to expectations currently? I presume that in IT, the expectations might not be heightened. But first, before we talk about IT, where do you expect the cuts to come in the most?
Well, let's step back and see where the good parts are. So then it will probably be easier to figure out that broadly we're quite positive on financials. And in fact, till recently we used to be quite positive on private banks. But incrementally, we are starting to think that investors should kind of broaden their horizons a little bit and look beyond that and look a little bit more into what is not always the high quality curve kind of companies, but even a little below. Maybe look out a little bit into NBFCs, even insurance for that matter. And so I think that will be probably where the positive surprise will likely come from. After these earnings, probably as analysts will start to cut their estimates for IT. And once those cuts are done, I think I'll be more interested in IT. But where the negatives or where the risks are looming, I would say could be around some areas of consumption. So consumer staples, for example, I mean, analysts still have mid-teens kind of earnings growth expectations. And, the best of the price hikes are behind. The best of the raw material benefits are probably behind. We're probably just in the peak quarter at the moment. So in the next 2 to 3 quarters, you probably will have some earnings cuts. Then consumer durables. We've had some unseasonal rains already, and sales of air conditioners and so on may take a bit of a backstage. I mean, of course, I believe inventory levels are still low in the chain, but over time, depending on how the monsoon pans out or how the summer pans out for that matter, you start to see numbers change. So I think consumer discretionary is not the greatest place to be. Selective, very selective there. And the last bit is probably autos, where while we are quite bullish on four-wheelers as a whole, and maybe even tractors for that matter, not so much on two-wheelers. So I would kind of isolate these areas, risk areas.
Okay. I would want to play the devil's advocate on a couple of these points, Abhiram. Let's start off with technology. I heard you say that after the earnings cuts are done, you will be interested in information technology. Now, my question is, uh, are you therefore saying that what Infosys has said and guided to is a company specific issue? Because if you're talking about a growth of 4 to 7%, then you're almost saying that FY24 was a washout year. So why should one go out and be constructive on IT? Because even if there is no price correction, there could certainly be a time correction.
Yes, very possible there could be a time correction, but let's step back a little bit. If you look at what happened in the last couple of years in IT services companies, you had, high teens growth for many companies. Some companies even grew more than 20% in terms of revenue. Now, that was never expected to last, right? Earnings estimates were always that at some point revenue growth will come back to low double digits or high single digits. So the guidance given by companies is not shocking by any stretch of imagination. If anything at all, they were probably 1 or 2% below what people expected, not 5 or 6% below. So this was somewhat known. Now the stock price reaction obviously is we've always seen this in the past that IT companies start to report and a small miss leads to a significant correction. And we've also seen that those corrections are often prove to be buying opportunities. It's rarely the case that after a massive correction or an immediate reaction, stocks start to go down even further. So the two likely scenarios from here, one could be that stocks undergo a time correction, which you mentioned, or alternatively, if you look at all the data points that are coming out, they're not that bad. In fact, IT spending tends to keep in line with the nominal GDP growth. And if inflation is still reasonably high, IT spending would also pick up. And moreover, you've seen we have a deal tracker at BNP where we look at how many deals have been signed every month and so on. And the deal tracker still looks very healthy. It's a conversion of those deals to revenue that's under question for the near term. And over the next 6 months, if you see, I think that that will start to convert incrementally into revenue a little better than what people are expecting. And it's possible that the guidance given by companies may prove to be conservative. So, I mean, I'm on that side of the camp which says that when they're good quality companies that correct a lot, you should start to look incrementally favorably towards them.
Okay. So in effect, what Infosys has guided to might be a company specific issue, Abhiram, because others may not. I think the ISG call also referred to that, because I'm just trying to think, even if Infi was conservative and if they do slightly more than four, I mean, let's say 7 to 8%, do the valuations capture that, or do you reckon that there could be upsides to some of these companies like which are guiding to maybe say mid single digit revenue growth?
Yeah. Neeraj, I'll keep my comments to the sector as a whole.
Yeah, sure.
And
I was using
and
that as
yes,
an
I mean,
example. I'm not asking you to
yeah,
comment
no, that's
on
true.
Infi specifically. Yeah.
No, that's true. Look, there will always be a range for companies. Some will be at the lower end, some will be at the upper end, depending on their own company specific issues. But I would say that broadly, the environment is not negative to the point that people were expecting. Going into the quarter, we felt that companies would be conservative to start, and that's happened. That's happened. But is the environment so bad over the next 3 to 6 months that we have to be cutting estimates? I think not. I think that this kind of conservative outlook in the beginning is always good enough for people to kind of make their estimates more sensible. And from there on, probably you'll start to see things start to improve rather than worsen.
Okay. The other place where I want to play the devil's advocate is staples. Now, I heard you say that you believe that there could be challenges there. The overarching belief, Abhiram, seems to be that rural growth might come back, one, which might help volume growth, part one. And part two, that a lot of the commodity cost pressures which plague these companies in calendar year 22 will actually be the reverse in calendar year 23. And therefore, even if commodity costs don't go down further from where we are right now, the year-on-year comparisons will certainly show fairly impressive volume growth numbers as well as margin numbers, and thereby helping earnings and the sentiment on these stocks. You disagree?
Well, there are various parameters we discussed there, but on volume growth is the main point here, right? Companies have come down to kind of mid single digit, even low single digit kind of volume growth at the moment. Now, as I mentioned to you earlier, price hikes were taken in the last 6 months or so. by companies to offset inflationary impact. And also raw material costs started falling quite in advance actually. So this quarter could have the best of both. So the fourth quarter results could actually be quite good on in year-over-year terms from an overall revenue growth perspective as well as the EBITDA growth. But over time, over the next 3 to 6 months, both of these effects will start to fade off, and then I feel that numbers will start to, they may not be bad still, but at the end of the day, the best quarter could be behind us. Now, the main variable here remains: will rural growth pick up? There's a decent possibility that it will pick up, but will it pick up to the point where revenue growth will be, high teens? Because volume growth would be high single digit and price gains of 5 to 6%. I would say that's more like a utopian kind of a scenario where, extremely positive bullish scenario. More likely, what will happen is high single digit revenue growth led by mid single digit volume growth and maybe a mid single digit pricing growth, and that's factored into estimates. So, in other words, I could say consumer staples is probably not the most exciting place to be at the moment.
Got it. I have one follow-up there, Abhiram, and that stems from a conversation with economists about what could happen to milk prices because of shortage of milk upcoming, and what could happen to wheat prices as well in light of the fact what's happening around the world. Now, my question is, if indeed both milk and wheat prices are supposed to be higher because of shortage in both of the commodities, so to say, could it be a problematic scenario for a QSR company or a company which is into biscuits and category leaders thereof over the course of the next 6 months on the margin front?
Yes, I think that is a genuine issue to worry about. In fact, it's not the first time we're seeing such issues, and that could come back to kind of affect estimates at some point. Now, that said, historically, what we've seen is that companies have also kind of managed, increased prices. We've seen that in the last 1 year also, right? When prices kept going up, raw material prices went up and down, and so on and so forth, and companies managed their pricing to a reasonable level. Why investors always tend to like consumer staples companies is because of exactly this. That over a period of time, they're able to manage the sharp movements of raw material prices, because ultimately they are staples. People buy, milk no matter what. So I think that will happen. But there could be a short-term impact of this in the second half. Again, ties back to what I told you earlier, that the best of the earnings growth may be
Exactly. Yeah, which is why I followed up with this. Um, um, Abhiram, the other point that everybody's or a lot of people are talking about is how to play the perceived peaking out of interest rates, even if we don't get cuts in a hurry. If rates indeed stabilize at the current levels, could it mean that sectors which had seen a bit of a derating due to the continuous hike in rates, can they make a meaningful comeback? Real estate, a case in point, for example. NBFC is a case in point. Can they make a meaningful comeback in sentiment and thereby pricing, even if business kind of stays steady or improves only marginally?
And there are a couple of ways to look at this. One is, of course, when rates start to peak, which I suspect is happening at the moment. And even if you don't have rate cuts in the second half of the year, which also I think will not happen, at least not to the level that investors are expecting. I mean, probably the textbook way to deal with it is to look at fixed income products. I mean, at the end of the day, you lock in a higher rate, which gives you a certain amount of interest income. At the same time, if rates start to fall, then you get a price benefit as well. So it's a dual gain. That would be the textbook answer to this. But if you were to look more into an equities perspective, there are ways to do this. You can look at REITs, for example. That's one way to benefit from higher interest rates. Anything that has a rental angle always is a good way to look at it. But from an Indian market perspective, right, ultimately you look at a basket of stocks that will benefit from this. By and large, I think financial companies will come out in a good position from this, because over a period of time, eventually they will gain from this. And see, ultimately, credit growth is still quite strong, irrespective of how high rates have become. Credit growth is still mid-teens, maybe even higher, and company balance sheets haven't been this good in a long time. So tells me that financials is probably the best placed in the scenario.
Not real estate. I reckon.
I mean, real estate, of course, it's a. That's why I mentioned REITs a little bit earlier. So it is one way to look
Okay. Yeah, playing it, but no, you're not inclined to play it through pure play real estate companies per se, because the sales numbers were okay all through the last 6 9 months. It's just that the sentiment got warped because of the high rates. You don't think that can reverse?
No, it probably will, right? It's just that in real estate, I would like to go much more granular in that sense, more company specific, and look at the numbers, balance sheet, and all that kind of stuff before I kind of conclude on what to do there. That's the reason why I was giving a generic answer.
Got it. Okay. Abhiram, a final set of questions. One is the street and the margin seems to be turning constructive on healthcare and pure play pharma within that. We've seen the screen in the last 20 days, enough number of days wherein pharma comes out as the top gainer. Some of the stocks have seen some sharp short covering led moves as well, albeit nothing sustainable. But we've seen the start of some bit of a revival of sentiment there. As a house, have you guys turned constructive? Or, I mean, I don't know what the earlier stance was, but is the current stance more constructive than the earlier stance?
Well, our stance has been, and we tend to take slightly longer term views on such sectors, has been positive on select areas. For example, we like specialty pharma. We weren't very keen on generics and US exposed names because of the pricing pressure. We liked domestic stories, we liked hospitals, and we still liked diagnostics. And this is based on pretty much a predictable sort of a low double digit kind of a top line growth, similar kind of earnings growth, and okay valuations. That's been our kind of long term call on the space. Now, where have we become incrementally positive? Actually, it's diagnostics, because those stocks have corrected quite significantly uh, after they lost their, the gains that they made during the COVID period. And post COVID, they were the first to kind of react negatively, saying this one big stream of revenue has gone away. If you look incrementally now, there's barely any COVID related revenue in the estimates. And companies are realizing that there's a lot of competition, and that competition, at least over the last 6 months or so, from online players and so on, but that is starting to go away now. It's starting to ebb, and people are thinking that if the industry model has to sustain, you have to increase prices at some point. And investors are not expecting a price increase at the moment, at least not a significant price increase. So if you start to see price increases, automatically the top line of companies start to improve, margins will improve, and the valuations have actually corrected quite significantly. So there's one space I would kind of isolate a little bit here and within pharma, apart from whatever structurally that I mentioned to you earlier, it's diagnostics.
Got it. Well, yeah. Let's see if indeed that turn happens. The valuations, as one of the fund managers was telling me, is the lowest that he's seen in its listed history for some of the diagnostic players. Let's see if it comes to the rescue.
Absolutely.
Sorry?
Absolutely, I agree with you. They're falling
Absolutely. Okay, great. My final question, Abhiram, and that is on things which kind of benefited from the reopening back in 2022, but are discretionary. The belief is that discretionary spending will continue to stay higher, call it the per capita or otherwise. And the fact that in select pockets there is hardly any supply, be it hotels, be it cinema chains, what have you. Maybe QSRs are separate, but the other two for sure. Are you guys constructive there? It's not a very large pocket. I'm still trying to understand.
Now, we are quite positive on some of those discretionary areas, especially, let's say, jewelry. We like that space, some parts of maybe real estate as well. So, I mean, if you can think from a 5 year perspective, 10 year perspective, there's probably very less doubt that India is getting more and more affluent. In fact, we did a pretty big report on affluent India last year, and we had a basket of stocks, including some of these jewelry names in it, and life insurance names, for example. All of these are a sign of an economy that's getting more and more affluent. So over a 5-10 year period, we pretty much think that will be the place to be. Now, this, of course, you have to juxtapose in the near term with where valuations have gone. In some cases, they've gone up quite a bit. So I wouldn't mind taking a bit of a pause. In case valuations correct, we get back into them as long-term themes, and then play it from there. But from a long-term perspective, oh, absolutely, they have to be part of the portfolio. If you're in India and you believe in the India story, it's hard to see beyond such names, right? They're affluent India names.
Affluent India. I think we did a conversation around that as well, Abhiram, when you guys released that note. And yeah, just thinking 1 year out or whatever, 9 months out, is the view changed or is it even more constructive? I'm liking the fact that you're telling me that taking a bit of a pause and reassessing things. Part two of that note, whenever it comes out, calls for all the conversation, Abhiram. But for now, we wrap it here on this leg of Talking Point. Thanks so much for taking the time out and being with us.
Thank you so much, Neeraj.
Yeah. And viewers, thanks for tuning into this leg of the Talking Point.